everybody. My name is Brittany Brooks, and I'm going to present to you Chapter 11, Long-Term Liabilities, along with my classmates. If they would like to pause the video right now and introduce themselves, they can. But once again, my name is Brittany Brooks. Sorry I couldn't be there. Yeah, I'm a little tired though, but we're going to get this done. Okay, so let's go. Chapter 11, Long-Term Liabilities. Oh, you can call me Professor Brooks. Here we go. Long-term liabilities. Investors, creditors, and others view the separation of liabilities into non-current and current classification as important so they can make decisions based on risk of the company, future cash flows, the performance of the firm. They can compare it to other firms, and they can just analyze everything to see if this is a good investment. So it's very important that accountants classify liabilities as current or non-current, so the decision makers can make a good decision based on the information. The definition of liabilities. So first we're going to talk about the balance sheet elements. You have an asset, which is the future economic benefit of the company. And you have liabilities, which is the probable future sacrifice of economic benefits from present obligations. And then you have equity, which is the residual interest in the assets of an entity that remain after deducting its liabilities. So the elements: assets, liabilities, equity. Assets equals liabilities plus equity. So once again, we have the definition of liabilities, which is the probable sacrifice or probable future sacrifices of economic benefits arising from present obligation of a particular entity to transfer assets or provide services. In other words, it's a legally binding obligations that are payable to an entity or person. So we have the recognition and measurement of liabilities. According to the Statement of Financial Accounting Concepts number 5, for an item to be recognized as a liability in financial statements, it must meet the definition of liabilities found in Statement of Financial Accounting Concepts number 6, and it must be measurable. So for an entity to decide to have a liability, it must decide, is it going to report the liability at the fair value, or is it going to report the liability at the present value of future cash flows discounted at the market rate of interest measured at future value? So it's up to the entity to decide how they're going to measure the liability. Whichever they decide, if they're going to measure it at fair value, or according to FASB Codification 825, the liabilities can be revalued at each reporting date if it's measured at fair value. So the fair values are reported in the balance sheet, and changes in the fair value are included in the earnings. So with the liability, sometimes it's hard to decide if the liability is a debt or it's equity. So there's about 13 factors to decide to determine if it's a debt or equity. Sometimes it could be classified as both. There's still work to be decided on how that's really going to be done, but some of the factors are maturity date, the obligation, ownership interest, settlement by issuance of stock, and debit or creditor, whether it's a debit or a creditor. Debit instruments typically have a fixed maturity date. Equity instruments do not have a maturity date. And then there's claim on assets. Creditors' claims take precedent over the owners. And then we have Statement of Financial Accounting Standards number 150 that require the following to be listed as liabilities. So a mandatory redeemable financial instrument such as redeemable preferred stock, and then you have financial instruments that embodies an obligation to repurchase the issued equity shares and may require the the issue to settle the obligation by transferring assets, and then you have an obligation to settle by issuing a variable number of shares of its equity securities. So all those I just listed must be classified or listed as liabilities. So my classmates can pause right here, and then everyone else can go until we get to the trouble restructuring or trouble debt restructuring. Or, here I am again, so we can talk about trouble debt restructuring. A restructuring of a debt constitutes a trouble debt restructuring if the creditor, for economic or legal reasons related to the debtor's financial difficulties, grant a concession to the debtor that would not be otherwise considered. So this can include modification of terms of debt. So modification in terms of debt is a reduction in the stated interest rate, the reduction of the face amount on the debt, reduction of the accrued interest. So you can do those things for the modification in terms of debt. You can transfer from the debtor to the creditor a receivable from third parties, real estate, or other assets to satisfy fully or partially a debt. Issuance of other granting of an equity interest to the creditor by the debtor to satisfy fully or partially a debt unless the equity interest is granted pursuant to existing terms for converting the debt into an equity interest. So there's more modification of the terms. The amount of principal and interest to be paid is greater than the current carrying value of the liability. Therefore, the debtor recognizes no gain. And then you have the amount of principal and interest to be paid is less than the carrying value of the liability. Therefore, the debtor recognizes a gain. So you have the satisfaction of debt through an asset. When debtor exchanges an asset or an equity and interest in satisfaction of the liability, the transfer is recorded on the basis of the fair market value of the asset or equity interest transferred. And then you have equity debt swap can increase reported income by the amount of extraordinary gain on the debit instrument or the debt restructure, and by reduce the interest expense. So there you have it. That's my portion of the long-term liabilities, and whoever's next, good luck. I'm tired. Gotta go. Bye.